From a weekly structure perspective, the market closed this week with a doji, which typically signals clear indecision between buyers and sellers at elevated levels. Price then attempted a push higher, but the move failed to develop into a sustained trend, instead leaving a notable upper wick on the weekly candle. On this time frame, that kind of structure usually reflects persistent overhead selling pressure and a lack of follow-through from the upside. This price action is more consistent with a false breakout and liquidity-driven move. Although price briefly moved above key levels, volume and structure did not confirm the breakout, suggesting limited bullish participation. In contrast, this provided more favorable conditions for sellers to engage at higher prices. From a structural standpoint, this does not invalidate the broader picture of overhead resistance and capped rebounds that has been in place. On the downside, the 84,600 to 84,900 zone stands out as the first meaningful area of short-term structural support. If this region fails to hold, the probability of continued downside expansion increases, and price action may begin to realign with the prior bearish leg. Looking at the broader time frame, the market still carries a retest risk toward the previous lows. Should the decline extend, the 80,000 level becomes a key psychological and structural pivot. A decisive break below that area would shift attention toward the 75,000 to 76,000 zone, where prior heavy trading activity and midterm structural support converge, making it a more significant reference area. Overall, price remains below the weekly resistance zone, and there is no clear evidence of a trend reversal at this stage. Under these conditions, a reaction-based, structure-focused approach is generally more prudent than chasing short-term moves. At this point, the analysis is centered on risk assessment and scenario mapping, rather than a directional conviction, with confirmation expected from how price responds around key support levels.